Okay, so we're back for another deep dive. And this time,
Yeah.
it's into the world of accounting.
Numbers.
Yeah, you sent over
Yeah,
the
fun stuff.
whole bunch of excerpts from an accounting textbook.
Absolutely.
And I gotta say, it is a lot
It's a lot to unpack.
to unpack, but
But it's the foundation of business, right?
yeah, it really
Yeah,
is.
we keep score.
It is. It's how we keep
Yeah.
score in business. Like,
Uh-huh.
how do we even know
Right.
if a company's doing well or not?
Mm-hmm.
So our mission today, I think, is to
Yeah.
really try to
Distill it down.
distill it down, find the core principles.
Find the golden nugget.
Yeah, the golden nuggets, and,
Yeah.
and try to connect them all.
Absolutely.
So let's dive right in. I mean, one of the first things that
Yeah.
that stuck out to me was this idea of inventory costing
Oh, yeah.
and revenue recognition.
Yeah.
It's like chapter 6.
The heart of it.
Right. Is chapter 6 in the material you sent?
It is. It is.
Like, when can a company actually say,
Yeah.
hey, we made a sale, we made some money?
When can you recognize that revenue?
Right. When can you recognize that revenue?
Mm-hmm.
So the book talks about this earnings approach, which seems to be
Yeah, the earnings approach, it's kind of the standard under ASPE, which is what private companies in Canada typically follow.
right.
It's kind of like the generally accepted accounting principles for private enterprises.
Okay, so ASPE is for the smaller companies.
Yeah, the smaller privately held companies.
Got it. Got it.
Now, IFRS, that's the big leagues.
IFRS is for the public companies.
That's the international, yeah.
okay.
Yeah. So it's more complex.
But what I thought was interesting is even though there are these two different sets of rules
Right.
for inventory costing,
Mm.
it seems like the fundamental principles are actually pretty similar.
At their core, yeah. You're still trying to figure out, okay, how much did it actually cost us to get this product ready to sell?
Yeah, like what are all the
What are the materials? What's the labor? What are the overhead costs?
right, all those pieces.
All those pieces that go into it.
And I noticed that the textbook actually has a lot more like practice problems and things like that in this chapter.
Oh, yeah.
Which is
They beefed it up.
they beefed it up, which is good.
Which is good because the more you practice this stuff,
yeah.
the more it becomes second nature.
The more it
Yeah.
becomes clear. Okay, so moving on. Chapter 7. This is about
Internal control.
internal control
So keeping the cash safe.
and cash. And it looks like they've added a new case study featuring David Stee.
Which is interesting because, everyone loves a good cup of tea.
Yeah.
And it's a Canadian company. So
It's relatable. It's something that
so I
people
get-
know.
Yeah.
So I guess they're trying to take these principles and
Ground it in reality.
In reality.
Yeah, because sometimes accounting can seem a little bit theoretical. But when you see how it actually plays out
Right.
in a company that you're familiar with,
Yeah.
it suddenly becomes a lot more understandable.
It becomes a lot more real.
Yeah.
Now, another thing they added was this little box on Bitcoin,
Oh, yeah.
which I thought was
very timely.
very timely.
Very timely.
Very relevant to what's happening in the world right now.
It really shows how accounting is evolving.
Yeah.
It's not just about
Try one.
traditional assets anymore.
It's not your grandpa's accounting textbook.
No, not at all.
All right, moving on to some of the
The big stuff.
big stuff.
The big stuff.
Chapter 9 is about long-lived assets.
Property, plant, and equipment. The things that make businesses run.
Right. And they
They have a new story about Kwantlen Polytechnic University.
yes, they do.
Yeah, a local institution.
And they even have a little nod to Game of Thrones
Yeah,
in one of the feature boxes.
I guess winter is coming for depreciation. Who knew that accounting could be so exciting?
Well, they're trying to make it relatable.
They are.
Okay, so with these long-lived assets,
Yeah.
the big thing is depreciation, right?
Depreciation. The idea that these assets wear out over time.
But they wear out. They lose value.
Yeah,
And there are different ways to actually calculate that depreciation.
absolutely. There's straight line depreciation, double diminishing balance, units of production. Each method has its pros and cons.
So straight line, that's
The
the
simplest one,
simplest one where you basically
you spread the cost evenly over the asset's useful life.
evenly over the asset's life. Okay.
Yeah.
And then you have double diminishing balance.
Double diminishing balance. That one front loads the expense,
Which means,
which means you take more depreciation in the early years.
okay,
It reflects the idea that some assets lose value faster in the beginning.
and that's allowed. Like you can just choose.
Yeah, companies can choose which method best reflects how the asset is used.
Okay. Interesting.
Yeah.
And then units of production.
Units of production, that's tied directly to how much you use the asset.
Okay.
So if it's a machine and you use it a lot in a particular year,
Yeah.
you're going to have more depreciation expense.
Got it.
Makes sense, right?
It makes sense. To illustrate all this, the book uses this example
J.J. and Company,
of J.J. and Company's delivery truck.
the delivery truck. Yeah, a classic example.
So
It cost them $25,000,
$25,000, they think it's going to last 5 years.
5 years or 200,000 kilometers,
Over 200,000 kilometers, okay.
whichever comes first.
And they also estimate that at the end of its life, it's still going to be worth $2,000.
That's the residual value.
The residual value.
I can sell it for scrap.
Okay, so let's break down how these different methods would work with that.
All right, so with straight line,
Yeah.
you take that $25,000 cost,
Uh-huh.
subtract the $2,000 residual value.
Well,
That leaves you with $23,000
$23,000.
depreciable cost.
Okay.
And you divide that by 5 years.
So $4,600.
$4,600 per year. Nice and straightforward.
Okay, that's pretty simple.
Yeah. Now, double diminishing balance,
Yeah.
a little bit more complex.
A little more complex.
You start by figuring out the straight line rate,
Okay.
which would be
Which would be 20%.
1/5.
20%, 1/5. Yep.
Okay.
Then you double it
So you double it to 40%.
by 40%.
And then you apply that to
To the full cost.
yeah.
To the $25,000.
Oh, the full cost, not the 23,000.
Not the $23,000, the full cost.
Okay, interesting.
So in the first year, you're taking $10,000 in depreciation.
Wow, that's a lot more.
It is. And then the next year, you apply that 40% to the remaining book value,
Oh, I see.
which would be $15,000.
Okay.
So it accelerates that expense in the early years.
Interesting. Okay. And then units of production.
Units of production. This one's all about how much you use the truck.
Right.
Let's say they drive 40,000 kilometers in a year.
Okay.
You take that $23,000 of depreciable cost, divide it by the total 200,000 kilometers.
Right. And then multiply that by the 40,000 kilometers driven.
So in that year, it would also be $4,600.
Exactly.
Okay.
So it directly ties the expense to how much you use the asset.
And what's interesting is the book mentions that you don't need to do any like partial year calculations with this method.
Yeah.
If you buy or sell the asset midway through the year.
It keeps it simpler.
It keeps it simpler. Okay.
Yeah.
So now moving on to patents.
That's sense.
A little bit different beast.
Okay.
These are intangible assets.
Okay.
You can't touch them,
Right.
but they can be extremely valuable.
Yeah, they can.
So a patent gives you the exclusive right to use an invention for 20 years.
Right.
In Canada, you get that from the Canadian Intellectual Property Office.
You're that hero.
CIPO.
Right.
And what's interesting about patents is that they're not renewable like some other types of intellectual property.
You get your 20 years,
20 years and that's it.
and that's it.
So you got to make the most of it.
Right.
Now, when it comes to accounting for patents,
There are some interesting things to consider.
like what?
Like, what happens if you have to defend your patent in court?
Okay, yeah, because people can challenge them.
Absolutely. People can challenge them, and if you're successful in defending your patent,
Yeah.
those legal costs actually get added to the value of the patent.
So it's not just an expense.
Not just an expense,
That's
you
like-
you're capitalizing it.
You're capitalizing it.
You're adding it to the value of the asset.
You're essentially protecting the value of that
Yeah,
asset.
exactly. You're preserving that exclusive right.
Okay, that makes sense.
And then you amortize that cost
Right.
over the remaining life of the patent.
Amortization. That's just the fancy word for depreciation for intangibles.
Exactly.
Okay. And then what happens when you're done with an asset?
Well, you dispose of it.
Right.
And the textbook gives us this example of a company exchanging limousines.
Okay, so they're trading in their old limo for a new one.
Exactly.
And how does the accounting work for that?
So the old limo originally cost $78,000,
Uh-huh.
but they've already depreciated $55,500 of that.
Okay.
So the book value, what's left on the books, is $22,500.
Okay.
The new limo costs $72,000,
Oh.
and they pay $52,000 in cash.
So they're trading in the old one and paying some extra to get the new one.
Right. And here's where it gets interesting. They actually record a loss on this disposal.
A loss. But they got a new limo.
They did, but the accounting looks at the difference between the book value of the old asset
Okay.
and the fair value of what they received in exchange.
So I guess the question is, how do they determine that fair value?
That's a good question. It can be tricky.
Yeah, because it's not a straight cash sale.
Exactly.
They're getting this new asset in return.
Right.
So there's some judgment involved there.
Absolutely. There's some estimation involved in figuring out what that fair value is.
Okay. So at the end of this whole section on long-lived assets,
Yeah.
the book throws out this question.
Taking it further.
Yeah, taking you further.
I like this.
They make you think.
They make you think.
So this one asks, should gains and losses from selling these long-lived assets be considered part of the company's normal operations?
That's a good one.
Or should they be treated as something separate?
Yeah, like a non-operating item.
Right.
So I guess the argument for including them in operating profit is that managing these assets, eventually selling them or trading them in,
Right.
it's all part of running the business.
Right. It's part of the normal course of business.
Yeah. But then you could also say, well, sometimes these disposals are kind of infrequent.
Right.
They're not happening all the time.
Right.
And they might not be directly related to the company's main activities.
So it might actually distort the picture of how the core business is doing.
Exactly.
If you lump it all together.
Yeah. So I guess it depends on what you're trying to understand about the company.
Right.
What kind of information is most useful for making decisions?
Okay. So there's no one right answer?
Not necessarily. It depends on the context.
It depends on the context.
Yeah.
Okay. Chapter 10.
Current liabilities.
Current liabilities.
Yeah.
And payroll.
Payroll. Everyone's favorite topic.
Right.
So current liabilities, these are the obligations that need to be paid off.
Relatively soon.
Relatively soon, usually within the next year.
Okay.
And the chapter starts by talking about the ones where the amount and the due date are pretty clear.
Like what?
Like accounts payable, money you owe to your suppliers,
Right.
unearned revenue, cash you've received from customers but haven't earned yet,
Okay.
and things like short-term operating lines of credit,
Right.
the money you can borrow from the bank on a short-term basis.
Okay. And then things get a little more interesting with uncertain and contingent liabilities.
Ah, yes. Where things get a bit fuzzy.
Yeah. Where the amount or the timing of the payment depends on something else happening. Example, like a lawsuit.
A lawsuit.
Right.
You might be sued, but you don't know if you're going to lose. And even if you do lose, you don't know how much it's going to cost you.
Right. So how do you even account for something like that?
Well, IFRS has some pretty specific rules about that.
Okay.
You only record a loss and a liability if it's likely that you're going to lose.
Okay.
And you can reasonably estimate the amount.
So if it's like 50-50?
If it's 50-50, or if you have no idea how much it might cost,
Yeah.
you usually just disclose it in the notes to the financial statements.
Okay. So you're not putting a number on it,
Not putting a number on it.
but you're letting people know that this thing is out there.
Transparency is key.
Transparency. Okay.
Right.
Now, the book has this example of a customer loyalty program,
Oh, yeah.
which I thought was really interesting.
Those points we all love to collect.
Right.
But from an accounting perspective, they're actually a bit of a headache.
How so?
Well, when a customer earns points,
Yeah.
the company has a future obligation to provide something.
Right.
They have to give them a discount or a free product or whatever it is.
So that's like a liability.
It is. It's a liability. But the tricky part is figuring out how much of that initial revenue from the sale should be deferred.
Deferred meaning.
Meaning they recognize it later
Okay.
when the points are actually redeemed.
Okay. So they have to make some estimates about how many of those points are actually going to be used.
Exactly. It's all about estimations and probabilities.
Okay. And then finally in Chapter 10, we get to payroll.
The nuts and bolts of paying your employees.
Right. And this affects pretty much every company out there.
Pretty much, unless you're a one-person show.
Right.
So we're talking about all those deductions that come out of an employee's paycheck.
CPP-EI.
CPP-EI, income tax.
Yeah, all that fun stuff.
And it's important to remember that employers have their own costs on top of that.
Right.
They have to match those CPP and EI contributions.
Okay.
They've got workers' compensation, vacation pay.
Right.
All those things add up.
So the total cost of payroll is not just what's on the employee's pay stub. It's all those extras that the company has to pay as well.
It's the full picture.
And they actually have an example.
Academy Company.
Yeah, Academy Company, where they break down
Yeah.
how you calculate gross pay, the deductions, and then those employer costs.
So you can see exactly where all the money's going.
Right. And then for anyone who's ever looked at their pay stub and been like,
Where did all my money go?
where did all this money go?
Yeah.
The book explains how to use those CPP, EI, and income tax tables.
Yeah, it breaks it down step by step.
So you can actually see how they come up with those numbers.
It's not magic. It's just math.
Just math.
Less.
Okay. So gross pay versus net pay, just to be clear.
Yeah.
Gross pay is what you earn before any deductions.
The big number.
The big number.
Yeah.
Net pay is what you actually take home,
What you can spend.
what you can
Yeah.
spend. Okay. And when the company's recording its expenses,
Yeah.
they record the full gross pay as salaries expense.
That's right. Because that's the total cost to them.
Okay. That makes sense. All right, moving on to Chapter 11. This is getting into
Financial reporting concepts, the big picture.
the big picture.
Yeah, the framework.
Okay, so we're not just talking about specific transactions anymore.
No, we're zooming out.
We're zooming out. We're talking about the overall principles.
The why behind the what.
Right. And it looks like they've added a new story about Cineplex
Oh, interesting.
and a discussion about the IASBs.
The rule makers,
Yeah, the rule maker.
the International Accounting Standards Board,
They're the ones who set IFRS.
they are.
Okay.
And they recently updated their conceptual framework.
Which is like the rule book for making the rule book.
Exactly.
Okay, so they're getting meta,
Laughs.
a little bit meta.
Okay, so one of the big topics in this chapter is revenue recognition.
Yeah, it's been a hot topic in the accounting world,
Right.
especially with the introduction of IFRS 15.
Right, that's the big new standard.
Yeah, it's a big one. It's all about when you can recognize revenue.
And it's gotten more detailed, especially when you have variable consideration.
Variable consideration meaning?
Meaning the price isn't fixed upfront.
Okay.
It might depend on discounts or returns or performance bonuses or things like that.
Okay.
So IFRS 15 has a few ways to estimate that variable amount,
Like what?
like the expected value method
Okay.
or the most likely amount method.
Okay, let's break those down.
All right, so the expected value method,
Yeah.
you look at all the possible outcomes,
Mm-hmm.
you assign probabilities to each one,
Okay.
and then you calculate a weighted average to arrive at the transaction price.
So it's like if there's a 30% chance of this happening and a 70% chance of that happening,
So you factor that all in.
you factor it all in.
Okay.
And the textbook has this example.
Wallace Construction Suppliers.
All its construction supplies. Yeah. They're selling some materials
Okay.
and there's a chance of returns.
Right.
So they use the expected value method to come up with an estimated price.
And then the most likely amount method.
Yeah.
That one's simpler. If there's one outcome that's way more likely than the others,
Uh-huh.
you just use that.
Okay.
No need to get too fancy.
Keep it simple.
Keep it simple.
Okay. And then there's this example with Gold Publishing
Gold publishing, yeah.
where they're selling books
Books.
and there's a possibility of returns and discounts.
Yeah. The joys of the publishing industry.
Right. And this example really walks us through the 5 steps
Yeah.
of IFRS 15.
It breaks it down nicely.
So we can see how they figure out the total transaction price,
Yeah.
taking into account those potential returns and discounts,
Right.
and then how they actually recognize the revenue over time.
As they satisfy those performance obligations.
Okay.
So it's a good illustration of how that standard works in practice.
Now, for those companies using ASPE,
Yeah.
the book talks about this earnings approach for recognizing revenue.
Yeah, it's all about when you've actually earned the revenue,
Right.
not just when the cash comes in.
Okay. So there are a few criteria they have to meet.
Right.
First, control of the goods has to have passed to the buyer.
So they can do whatever they want with them.
Right. And the seller can't still be
Right. Micromanage.
micromanaging things.
Yeah.
Okay. And you have to be able to reliably measure the revenue and costs.
So you know how much you made and how much it cost you.
Right. And there has to be a high probability that you're actually going to get paid.
No deadbeats.
No deadbeats.
Laughs.
Okay. And there's an example with Charisma Company
Charisma Company, yeah.
where they're selling merchandise.
Yeah.
And it shows how the revenue is recognized once those conditions are met.
It illustrates those key principles.
Okay. So it's not just about when the cash changes hands.
No, it's more nuanced than that.
It's more nuanced.
Yeah.
Okay. Now, this chapter also gets into different ways of measuring value.
Beyond just historical cost,
Right.
which is what you originally paid for something.
Right.
So we're talking about fair value,
Yep.
current cost, realizable value, present value.
Okay. So fair value.
Fair value. What you could sell something for today in the open market.
Okay.
Current cost. What it would cost to replace that asset today.
Okay.
Realizable value. What you could get for it if you sold it, less any selling costs.
Okay.
And present value. The value today of future cash flows.
So like if you're getting a stream of payments over time,
Yeah,
you can calculate what that's worth right now.
exactly.
Okay. And then the chapter talks about the qualitative characteristics.
The hallmarks of good accounting information.
Right. So this is what makes financial information useful.
Useful for decision making.
Right. So you've got relevance,
Relevance.
faithful representation,
Faithful representation.
comparability,
Verifiability.
verifiability,
Timeliness.
and understandability.
Understandability.
Okay, so relevance.
Relevance means the information actually makes a difference to decisions.
Okay.
It's not just noise.
It's material.
It's material.
faithful representation.
Oh,
That means the information is complete, neutral, and free from errors.
it's accurate.
It's accurate.
Okay.
Comparability means you can compare the information to other companies.
Right.
Or to the same company over time.
Right. Apples to apples?
Apples to apples.
Verifiability.
Verifiability means different accountants should be able to reach the same conclusion.
So there's some objectivity there.
Objectivity. Yeah. Timeliness means the information is available when it's needed,
Right. It's not stale.
not stale.
Okay.
And understandability
Understandability.
means someone with a reasonable grasp of business can make sense of it.
So it's not just for accountants.
No, it's for everyone.